So I already have a video on the cost of care in retirement for a long-term care event. Today I'm going to talk about how do we actually solve that problem and what are some strategies that you can do to help implement and cover that cost of care in retirement. So I'm Derek Mazzarella, Certified Financial Planner with Gateway Financial Partners, and today we're going to talk about how to handle a long-term care event. So most people I talk to say, okay, how do I hide my assets? And when they ask that question, I know they're typically talking about applying for Medicaid. But most people don't really fully understand what that means. So if you are able to get Medicaid, you have to actually meet a certain benchmark. And you basically have to have very minimal assets. So you need to have, as of 2022, $2,000 in assets for a single person, and you need to have income of $2,500 a month or less. So if you're over that, you may have some challenges getting Medicaid coverage. If you're going to try and hide your assets, they do have a 5-year look-back period. So it's not something you can just do, oh, I'm sick, let me start hiding some assets or gifting to my grandkid Bobby Joe, okay? That's going to take some heavy planning to do prior to that. The third piece of it is usually the big one, is now the government is really just determining your care. So you don't get to pick which Medicaid facility you go into. They're going to direct you to say, okay, well, this is what we have open spots for, this is the care you're getting, and whether or not that's actually better care that you can get on your own is probably debatable. Most people would probably tell you no, but I don't know if you want to have more control over your situation than that. If you do, there's a couple things that we can look at. So the first one is self-funding. It's really just a fancy way of saying, I'm going to pay for this myself. So when you look at that, there's a couple of challenges with self-funding. Typically, the cost of long-term care is pretty extensive. So in the first video, we mentioned that long-term care costs anywhere from $300,000 to $650,000 or $700,000. That's a large sum of money. So if you're in that middle spectrum range, or maybe have a few $100,000 saved or just under $1 million saved, you may have some challenge paying for that, or at least the full cost of care. Because as I mentioned, care is going to last 2 years, 3 years, 4 years. If you have Alzheimer's, unfortunately, that's a very long-term illness. So that can cost a lot of money over time. You may not have the assets to support that. Two, the other issue with that is you're kind of, if you're allocating and hiding assets and putting assets away, banking that, okay, at a future date, I may need some long-term care, there's an opportunity cost to that, because that means that's money you can't spend in retirement. That's money that you're not sure you can spend because I may have this issue later, so it may reduce your actual enjoyment overall of retirement while you are healthy. So generally I find self-funding makes sense when you're kind of at two ends of the spectrum when it comes to assets. So if you're in the low end, generally I've found it's better if you spend your money first, go into a facility, then it goes to a Medicaid, because then you have some control over the type of facility you have. So if you can spend a little bit first, pay for those first few months of Medicare facility treatment, then you're going to have your choice of Medicare facilities, which would help. On the other end, you may have so much money where it doesn't matter. You're just going to be able to fund it yourself. That's definitely something that you can certainly do. The other option is you can look to pass the risk off to an insurance carrier. And there's really two main options when it comes to that. There's a traditional long-term care policy, and then there's a hybrid policy. So a long-term care policy just really covers insurance for a long-term care event. And that basically means you can't do two activities of daily living. So you can't bathe yourself, you can't feed yourself, you can't go to the bathroom by yourself. It covers cognitive issues. So things like that, that's when it would essentially kick in. And long-term care is meant to pay a benefit out to you to cover, in-home care, nursing care, facility care, any types of care like that. They will essentially write you a check based on your daily amount. So basically when it comes to long-term care, there's three questions. When are you getting paid? How much you're going to get paid? And how long are you going to get paid for? So typically you get paid usually after about 90 days. You have a waiting period, so you can't just be sick for 3 weeks and then collect a benefit. You have to be out at least 90 days. You do have some flexibility of choosing that yourself. How much? They typically run what's called a daily benefit. So you may have a daily benefit of $150 a day, $200, $300. You get to choose that. A lot of plans now have compound growth in that, so it'll allow you to actually increase that amount because, as we know, inflation does happen, especially when it comes to medical expenses. So it will actually help grow over time. And then how long? Typically you're buying it for a period of years. So you may buy it for 3 years, 4 years, or 5 years. Those are kind of the traditional bands of that. So basically, it's going to give you this pool of money. It takes the number of years times your daily benefit, and that's your overarching amount of money. So maybe something like, okay, we have $250,000 that you can spend on long-term care later on, which if you have inflation will grow with inflation. So it's a way to pass the risk off. You pay typically a annual premium for the long-term care. Typically the best time to start looking at when to buy long-term care is your mid to late 50s to your early 60s, because that's generally when the price is going to be good enough to cover what value you're getting from it. One thing to look out for when it comes to long-term care is that the premiums are not locked in. So they can go up over time. So there's definitely something to watch out for if you're considering buying a long-term care policy. Okay, now when it comes to hybrid policies, one of the biggest complaints I have, or reasons that people don't want to buy long-term care policies, I put all this money and pay all these premiums for 20 years and I never get sick. What happens? The insurance carrier wins. They get to keep the premiums. Right? That kind of sucks. So a way around that is called a hybrid long-term care policy. It basically blends a death benefit with long-term care. So generally how that works is you put usually a chunk of money in front. A lot of these hybrid policies you have to put in $50,000, $100,000 day one. You get a pool of long-term care, but then you also usually either get your premiums back or maybe that grows and you get a death benefit back from the policy. So it does solve that issue of paying your premiums forever and then never actually getting a benefit for it, because you're either going to die or you're going to get sick. One of those two things is going to happen. I found that long-term care policies can be a little bit more confusing. You do want to watch out for, because not all of the death benefit are tax-free. So some of them are return of premium. They may not be tax-free benefits. And sometimes the long-term care benefit doesn't quite cover as much as you would with a traditional policy. So you're usually giving up something with a hybrid policy. You just want to make sure you try and understand what you're giving up. The other thing that you do have, some whole life or permanent life insurance policies will offer a long-term care rider where you can access a portion of the death benefit to cover a long-term care cost. One thing to look out for with those is they typically don't have an inflation rider. So if you're buying that at 35, you're kind of stuck with whatever death benefit you had when you bought it at 35. So that's definitely one thing to consider, because like I said, inflation does happen. So there's a couple other benefits to just going the insured route in general that aren't necessarily just paying for long-term care. One is the tax piece of it. Typically benefits from long-term care are tax-free. So if you are in that high income spectrum, maybe shifting some money to a long-term care policy and using tax-free benefits is more beneficial, because you're not selling assets, paying taxes, then writing a check to a long-term care facility. You're just paying for the insurance, and then once you need the benefit, now you're getting a tax-free long-term care benefit for yourself. So that's one piece of it. And two, there's some other little things to it. There's a lot of states have a Homestead Act where if you buy a long-term care policy, you actually protect the value of your home. So in case you did need to go in a Medicaid facility, let's say you did exhaust all your long-term care funds, you're still sick, you still need to go to a care facility, you have no other assets other than your house, the long-term care policy will help you protect that, which is huge. And then third, a lot of long-term care policies will have a coordinator. So if you need help coordinating facility, filing claims, figuring out where to go, that's kind of a unique benefit that long-term care policies have, because if you're going through this illness, you're usually not in a good spot. Now you're putting a lot of pressure on your family members to help either care for you or find a facility. Having a care coordinator can help alleviate some of that stress. So the real big thing too is with long-term care policies, especially if kids that are out of state that can't care for you, it's a way for them to say, hey, look, we know that mom and dad are going to be okay if something ever happened to you, because we know you have benefits there. We know you have a care coordinator there. We know you're going to be taken care of, and we know that you're going to be okay, at least on that side of it. So when it comes to solving this big problem, like I said, it's a very costly issue. It's very probable 70% of people will probably need some form of long-term care in retirement. So the things you can do about it are look at Medicaid planning. You give up some control. You do have to have very little assets. You can look at self-funding. It puts a lot of pressure on you and your assets to help pay for a huge expense in retirement that can be anywhere from $300,000 to $600,000. Or you could look at passing the insurance off to a traditional long-term care policy or insuring it with a hybrid policy. So there's a lot of things you can do, a lot of decisions you have to make, and you have to find out what's right for you. But if you have any questions, feel free to reach out. I'm here to help. And if you like the video, please feel free to like and subscribe. Derek Mazzarella, Certified Financial Planner with Gateway Financial Partners.